Well, hello out there. My name is Keith Rushing. I'm president of ICOVEST Capital Group, and I want to take about 10 minutes of your time and talk to you a little bit about reverse mortgage and how you can harness the power of your equity to help your financial world. So let's get going. So, reverse mortgage is defined. A reverse mortgage is an FHA HUD home equity conversion mortgage that allows homeowners 62 and above to convert home equity into cash without monthly payments, repaid upon leaving the home. There's also a jumbo reverse that addresses homes and borrowers that do not meet HUD requirements for ages 55 and over. Many reverse mortgage options are available. You can eliminate your mortgage payment, you can free up cash, create an additional monthly income, have a line of credit, or a combination of the options above. You can buy a new primary home or a second home, or take the cash and invest it in something you want. So there's a lot of different options. The reverse mortgage is designed to help the largest demographic of people in America utilizing their equity to improve their financial situation in their later years. Why consider a reverse loan? A line of credit that continually grows. You can protect your investable assets, delay drawing from Social Security, purchase real estate, create a financial safety net, provide additional funds for retirement, and all of the proceeds are tax-free. They do not consider this income. Additional homeowner benefits help you to maximize long-term gains while minimizing your risks. The assurance of safe withdrawal rate, protecting your lifestyle. Having funds for long-term care. A lot of the boomers don't realize that their insurance does not cover long-term care, and this provides funds to be able to help you take care of that. Funds to help a grandchild with their first home purchase, having funds for your bucket list. So again, the list goes on and on of the benefits of a reverse mortgage. The differences: on a conventional mortgage, you're increasing your equity, and a reverse mortgage, you're increasing your liquidity. Now let's look at some of the things that are the same and some things that are different. There is no age restriction on a conventional. Monthly payments are required. Your equity increases, your loan balance decreases, and your liquidity decreases. Borrower owns the home. Property taxes, insurance, and maintenance must be paid. Risk of foreclosure if payments are not made. No ability to preserve retirement funds. So in reverse, there is age restrictions. There is no monthly payment. Equity decreases, loan balance increases, but your liquidity increases. Borrower owns the home. Property taxes, insurance, and maintenance must be paid anyway. It is a non-recourse loan, and you're able to preserve your retirement funds. Now, let's look at property eligibility. It must meet Federal Housing Administration property standards and flood requirements. This is what qualifies: a single family home, a 2 to 4 unit property, a HUD FHA approved condominium or townhome, manufactured homes that meet FHA standards, and also new home construction, which is kind of a new wrinkle in the reverse mortgage world. So now let's look at what are the financial requirements. There's really two things: willingness and capacity. Willingness has to do with the history of your payments, your credit payments, your tax, insurance, rent, no outstanding federal debt, that you're a responsible financial person. Capacity has to do with income, that you need residual income and or additional assets to cover your living expenses and your utilities. So let's talk about some different examples here. And the examples I'm going to use are homes that are free and clear. If you've got, if you still owe on a mortgage, it's going to change the numbers a little bit, and I can help you get exactly the numbers that fit you. But for the sake of these examples, where everything's paid for. So we have a 70-year-old couple sell their home for $500,000. They want to downsize to a new home of $350,000. Now they can pay cash and have no mortgage payment, or they can use a reverse mortgage, have no loan payment, and keep a greater amount of the cash proceeds. Let's see what this looks like. So you got the sale price of $500,000. You got the cost of selling and buying. Net proceeds $460,000. New home price $350,000. You take $350,000 out of the $460,000. You've got $110,000 left. Not bad, but let's look at the reverse. Same scenario: $500,000. 40,000 for the cost, 460 is remaining balance. New home price 350. So in this case, you take out a reverse mortgage for the purpose of 110. Then you contribute 240 from the sale of your home, and now you have $220,000 dollars in the bank, and you still are not making a payment. Another situation: a 70-year-old couple want to sell their home for 500,000 and purchase a new home for 650. So, and they don't want any mortgage payments. So how are we going to do that? Well, let's take a look. Sales price 500,000, cost to sell 400,000, net proceeds 460, new home price 650. Now they've got to come up with an additional 190,000 to make that happen with no mortgage. Now let's look at the reverse side. Same thing: 500,000, 40, 460 net proceeds, new home price 650. They get a reverse mortgage for 206. They contribute 390 from the sale of their home. Now they have 16,000 still in the bank and no mortgage payment. Now here's kind of an interesting one. 70-year-old couple want 50,000 help their grandson purchase his first house, create a line of credit for emergency funds, etc. And they really would not like to have to make a payment. So let's see what it looks like. We got a market value of 700,000. The cost to set up the loan and the mortgage insurance, 23,000. Cash advance, 50,000 for the grandson, leaving an initial line of credit of 194,835, and no funds are required. Now let's look at how this line of credit grows. So in year 5, that line of credit has gone from 194 to 287. And if you look at the line of credit in year 10, now it's grown to 423. And if you look at the year 20, that line of credit has grown from 194 to 921,000. And if you notice, the equity is growing every year as well. And equity after 20 years has grown to 1,176,000. Now that equity growth is based on this loan and the agreement in the loan documents that it is going to grow. So regardless of what your property value does, going up, going down, your line of credit and the value stays with your loan. Now let's look at a jumbo loan. So we have a 57-year-old man who wishes to purchase a new home without incurring monthly mortgage payment after selling his home for $1.5 million. So he's looking for a new home of $1.8 million. He sells his home for $1.5 million. 8% the cost of doing business. Net proceeds $1,380,000. New home price $118,000. So he's going to have to come in with $420,000. Now, if you've got that kind of money to buy that kind of home, maybe that's not a problem. But now let's look at it from a reverse standpoint. So you've got the sale price of a home, 1.5, net proceeds 138, new home price of 1.8. Now you take out a reverse on the mortgage, 522, the contribution from the proceeds 1,118. Now you have funds in the bank, 101,000, 102,000, and you have your home with no mortgage payment. So there's also strategies to protect your investables. Just very quickly, if you are trusting your income through the market, what happens when the market goes into a downturn, and who knows what the future holds. So if that does happen and you have a line of credit with a reverse mortgage, what you do is you don't touch your market. You use the line of credit in your with your equity. You protect your nest egg, and when the market comes back, now you go back to the market. You stop taking funds from your line of credit, and you can pay back your line of credit as you want. So if you want to rebuild or build up a larger line of credit, you can do that with your own money, and you become your own bank, so to speak. So let's talk about repayment options, because this is a real this is really key, because a lot of people are scared to death of their heirs don't get anything. But here's the deal: the heirs keep the property. They can pay the loan in full, never more than 95% of the appraised value. They can sell the property, repay the loan, remaining funds to the heirs. No financial liability or debt is passed to the heirs. They can do a short sale if the market is a little dodgy, or they can just walk away. If the property is underwater, that the loan is greater than the value of the property, walk away, no financial liability. So, are you 55 or older that you could benefit? Do you have friends or family that could benefit from a reverse mortgage? And if you'd like to learn more about a reverse mortgage to your personal financial needs and desires, look, I specialize in this product, and I am here to help. And here is my contact information. You can call me, text me, or you can email me, and I look forward to having a conversation. And thank you for taking the time to go through the video.